welcome along to the Property Academy podcast. I'm your host, Ed McKnight.
And I'm Andrew Nicol.
And today on the show, we're doing a rapid fire. This is one of my favourite types of episodes where we take a whole heap of the questions from our most recent webinar, 25 in total, and we run them through in under 15 minutes. Now, Andrew has not seen any of these questions apart from, if he remembers, one or two of them from the webinar. So we're going to rip through them and get his immediate thoughts on these. Number one, Christchurch or Wellington? I already have an investment property in Christchurch.
Christchurch, because Wellington's so overpriced at the moment, and that's on the assumption that someone's looking for growth, because the bulk of investors that come to us are looking to invest for growth right now. If you're buying for yield, absolutely Wellington.
You recommend Christchurch often? Seems almost biased.
Interesting you ask this. So I am not biased when it comes to money. I'm not patriotic when it comes to money. I'm from Christchurch, but I don't care where my money comes from so long as it comes. And at the end of the day, I just think for the last 5 years, there's been such an opportunity in Christchurch, and I guess we've now got a platform to talk about it. You will hear me talk about Wellington over the next wee while. You'll hear me talk about Queenstown, all the places that I've been kind of saying not to invest in. You might not hear me talk about West Coast, but for money, it really comes down to where you're going to get the most of it. That's why I talk about it. Absolutely not biased at all. You're not buying any of my houses.
Hi guys, I'm new to property investment. How do you use equity from your own house to buy an investment?
Cool, great question. So you've got a thing called, you've got the value of your house, and let's just call it 500,000 because I use that number a lot and it's easy for my head, especially on a Monday afternoon. And then you've got your value of your mortgage. So let's call that 200,000. So your equity is 300,000. You can't borrow all of that equity. The bank needs to have a margin in there to protect them in the case you don't pay your mortgage and they've got to sell the house. So what we look at is what's called your usable equity. So the way you work out that is you go 500,000 times 80%. Because it's your own house, you can borrow up to 80% subject to servicing. So 500K at 80% is 400,000. Your mortgage is 200,000. That leaves a differential of 200,000 as well. So that's your usable equity. You can take that out as a deposit subject to servicing and bank criteria. And if you're buying a brand new property, you can multiply that by 5 because you can borrow 80% again. That gives you $1 million worth of purchasing power.
Prediction for what growth prospects of Queenstown will be?
That's a hard one. I think I remember answering this on the webinar live. I would be a little cautious with Queenstown because I don't think they've felt the full brunt of its pain just yet. I think there's probably a little bit more to come. I'm going to be there this week and sussing out the market yet again. We're just keeping a really close eye on it. There's always opportunities when there's a catastrophe, earthquakes, GFC, all these kind of things, the COVID. I have made money in all of these disasters, but I do think Queenstown is reliant on the borders opening up again for it to really recover and or grow. When those borders open, there will be an influx of people. So it's having the right opportunities at the right time there.
LVRs, do they apply to second tier funders?
No. So LVR restrictions. So LVR is just loan to value ratio. So LVRs are everywhere. LVR restrictions are by the Reserve Bank, and banks are governed by the Reserve Bank's rules. If you go to a non-bank lender, no rules apply.
But what about in a hot market such as what we're experiencing now? Still a good idea to get your properties evaluated when you get a new mortgage?
Absolutely. I mean, if you're looking to take out the equity and you recycle that deposit or buy another property, absolutely keep on top of your evaluations and find out where the usable equity is. As soon as you can buy another property, as soon as you can borrow more money, do it, because you don't know when that tap will be turned off.
Tough question here. Do you know who Maggie Z is?
I know who Maggie Z is, yes.
What gross yield would you typically expect from new build townhouses in a main centre?
Christchurch, I would say you're probably looking at about between 4 and 5%. Wellington, you're probably looking at about 4 to 5%. Auckland, you're probably looking at about 3% gross yield. But we always focus on the net yield. It's bottom line that matters. Remember, turnover, vanity, profit, sanity.
Hi, Andrew. Do Do you think now is a good time to fix the bulk of your mortgage at a low rate for the short term, like 1 year, or do you break it up and spread it out?
That's a great question. That's quite a personal question. So one of my investors that I'm working with spoke to me the other day. They have gone for 5 years. I wouldn't fix for 5 years right now personally because I want to see the bottom of the market, and we don't know what it is until afterwards. So we've just got to take a bit of a gamble. Me, as somewhat of a gambling man, like to play a roulette, I am absolutely just fixing for 1 year at a time, particularly with my personal mortgage. With some of my investments, I go a little bit longer, but generally speaking, it's short term. If your circumstances require certainty, for example, let's say you are on maternity leave, or one of yours on maternity leave, and you know that probably for the next 5 years you're going to be on a reduced income, and you know that on the 5-year rate you can afford a top up of $20 a week, and that's what it works out to be, then there's nothing wrong with fixing for 5 years and having that certainty. That's what a longer rate allows you to do. But if you're asking me what I think rates are going to do, they're going to go down. I imagine over the short term, I would absolutely be fixing for a year at a time, which also gives you flexibility if they come down a bit more, or even if they start to creep up and you want to break it and fix it again.
Which is better, new 4-bedroom homes or two bedroom townhouses?
That depends. I mean, if you're looking for growth, generally speaking, you'd probably think that maybe a 4-bedroom house, but I think they're pretty similar. And Ed, you know the data on this more than me.
The difference in capital growth is pretty unclear, which you get more capital growth on. The main question is, is it really a choice in terms of what you're going to invest between one 4-bedroom house versus two bedroom townhouses? You're not going to get two bedroom townhouses for the same price as a one 4-bedroom house.
I mean, if you can buy two bedroom townhouses, but only one 4-bedroom house, I'd buy the 2 townhouses.
But that does allow you to have more diversification as well. What's the LVR for new builds under the new rules?
There's no restrictions. So the banks will allow you, generally speaking, to go to 80%, but technically they can lend you 100% if they want. And you will see, in my opinion, some banks come out there and push the envelope over the next wee while. Maybe in a future show we're going to talk about what we would do if we were the government. What would Andrew do if he was King of New Zealand? And God forbid. And
you already think you are.
I definitely think that you will see a lot of encouragement towards putting stock into the market, and so there might be 90%, 95% for new builds, be it owner-occupied or an investment. But right now, there is no restrictions. The banks can do whatever they like, but expect them to do 80% if you want normal rates and interest only, etc.
Do you think internal migration away from Auckland into the regions may have a bigger impact over the next few years?
Yes, I do. I think part of that is after COVID, we learned how to work remotely a lot better. It's been really interesting how now I go to Auckland and I see clients in Wellington because I'm using Zoom. Even investors that I'm working with in Auckland might choose just to see me on Zoom while I'm there rather than drive into the city.
Rolleston. Is it a small town or a main city?
It's a small town in a definition.
Is it better to invest in Auckland or Hamilton?
It depends on what you're looking for. Right now, as of today, I would probably be going Auckland because the prices for Hamilton are pretty comparable. You're paying pretty much the same dollar value to get something in Auckland as you would in Hamilton, but the rents aren't as strong, and so there's likely to be a top up or less of a cash flow. In Auckland right now, it's right for the picking. The values are reasonable, the rents are good, and the growth prospects are high.
Is there a relationship between longevity of a tenancy and yields? He's taking too long to answer that.
I was considering it through. Sometimes if you've got a tenant that's going to stay for a long time, you are likely to give them a discounted rent, and so accept that, lower vacancy. Lower vacancy means that you can accept a lower level of rent.
So you're right in saying that there would potentially be a lower gross yield because you're not increasing the rent at the rate that the rest of the market is.
Yeah,
but you might have a higher net yield because you might have a higher level of vacancy if you're continually putting up that rent and your tenancies are short. shorter. Plus, you're paying higher net yields. Is a higher rental yield, for instance, in a small town, a reward for taking on greater risk?
Well, I think actually part of it is that you remember in a smaller region, you've got a higher cost base. And we talk a lot about this in the webinar, so refer back to that. So the fact that you might take 8 weeks to recoup your rates, your property rates that you pay, compared to, one of the main centres might be only 4.
That's right. So you got higher costs in some of those small towns, and so you're potentially charging higher rent. So that's why. Andrew, you mentioned earlier that small towns, the population and popularity can be based on a single occupation or industry. Let me ask you this. Are there any small towns where you expect their local industry to boom?
Queenstown, when they reopen the borders, I think that's probably a big one. Right now, they've lost a lot of people to people returning overseas. Now you're probably going to see a lot of influx into Queenstown once the borders open, once we've got this COVID under control. I also think that, we've got to remember things like autonomous driving is going to change the way we do things. So places like Hamilton, maybe places like Tauranga, and people working in Auckland, there might be a lot more commuting. That's probably going to be a big thing. I can't think of any industries off the top. Oh, actually, you had a good one, didn't you, Ed? What was it? The milk factory or something?
No, it was Rocket Lab.
Damn it, that was at Rocket Lab.
Which is near Wairoa. I said potentially you'd see a lot more activity there as it ramps up, particularly of relatively high earning individuals just south of Gisborne.
I wouldn't put all my money on that, though.
No. But it was an example.
It's a great example.
Now, the next one on our list, how long do you think new builds are going to be exempt from the LVR rules?
They'll always be exempt until we've solved the housing crisis.
And down the same line, how long do you think the LVR will remain at 40% for existing property investors?
2 years until National get back in.
Oh, bold prediction. Hey, mate, thoughts on crypto for 1% of my portfolio?
Look, I don't know enough about crypto to really comment. I'm barely figuring out how to use the interweb, so I don't know that I'd be the best person to talk about crypto. Darcy Unguro, who has a really good podcast, the Everyday Investor podcast, I know he's got an episode on this topic, and he invests himself, and Ed and I were just talking about this over dinner the other day. He's like, look, I don't understand a lot about it either, but, if someone puts in $5, 10 years ago, it's worth like $1 trillion now. It's crazy. So I do think maybe, I might put a little bit of a punt in there, but I wouldn't hang my hat on it.
There was a particularly good episode on the New Zealand Tech podcast, which Darcy was featured on because his podcast is on a similar network that was going through crypto from quite a few perspectives. It was very interesting. If our producer reminds me, then we'll link it in the show notes. Number 21, we've got 5 questions left in about 2 minutes. What's the average national capital growth over the past 21 years?
6.5.
Close at 7%.
Yeah.
What's the likelihood that the tax treatment will change in deducting interest expenses?
We're going to do an episode on this. I think it's highly unlikely, but we'll cover this more in the next episode.
Why not just invest in multi-income properties? So home and incomes, get the best of both, yield and growth.
I don't know the stats around those, but I don't know that they're as good as just a high growth property.
And what's the difference between instant equity and capital growth?
Instant equity is normally because you've done something, you've renovated a house or you've negotiated a really good deal, and the day of settlement or the day of you completing your renovations, you have actually turned $1 into $2, whereas capital growth happens over time.
And last one, number 25, could you purchase a property in a small town, subdivide it, build another property, which then creates capital gains as well?
Well, that kind of ties into our last question. You're actually doing something to make that growth. So you're manufacturing that growth. It's not natural capital growth.
Fantastic. So that is a rapid fire 25 questions. Did we do it in 15 minutes? I think we just scraped in there. I love to do these sorts of shows. The reason is that often we get so many questions and we might have answered that back in episode number 13, but now we're up to episode 530 something or other. And we need to recap these for new people who have joined the show, but we still want to keep it entertaining for our long-term listeners as well. Hey, look, let's wrap it up there, but please don't forget to rate, review, and subscribe to the podcast. It really does help us get the message out to more people. And of course, if you have a topic you'd like us to talk about, either email us. My email is ed@opespartners.co.nz, or just flick us a text, whip out that phone. Our number is 5522. Thanks Thanks for listening to the Property Academy podcast. I'm your host, Ed McKnight.
And I'm Andrew Nichols.
And we're going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the New Zealand property market. Until next time.